I'm Michael Hall, the Director of Sales and Marketing here at the Milner Group, and we're really glad that you could join us today. This year, our in-person events and webinars are going to be under the theme of Retirement University. All of these are going to be targeted at trying to give you simple, easy ways to present potentially complicated issues to your clients. We know that there's revenue opportunities and real value add opportunities in some of the topics we're going to be presenting, and we want to help you get a better handle on how to do that in a way that's helpful to your clients and prospects. And so today we have Jake Bailey, our resident insurance and planning guru, who is going to be painting a picture for how you can position life insurance as a retirement asset. Again, we're glad you're with us. We look forward to helping you leverage these ideas into opportunities with your clients that will really be a difference maker for them and will also generate additional revenue for you. So with that, I'm going to turn it over to Jake and let him take it from here.
Thanks, Michael. I would like to thank everyone for taking the time to be on the call today. I know that your time is very valuable, so I really appreciate your attendance today. Today we're going to discuss the place of life insurance in a retirement plan. You've probably heard of a, quote, LIRP before, life insurance retirement plan, but if you're like many of our agents, you may be unclear exactly how it fits into the retirement landscape and how it benefits your clients. So my goal today is to show you why life insurance makes sense in retirement, what you need to know to begin to implement it into your practice to help your clients and hopefully to earn more revenue. We've began to have a lot of traction with this last year with this concept, and what we've seen is that it's not taking away from other sales in any way. Really, it is adding new sales to your practice and to the Milner Group that you wouldn't have gotten before. So we're trying to open the door for new opportunities for you and for your clients. So as we go through the webinar today, I would appreciate it if you would think of your current clients who you would think that would benefit from this concept. And then we can talk about it later. So let's get into it. So when you talk about what is one of the main arguments that is given when an advisor is justifying a client having most all of their money in a traditional qualified plan, say a 401k, where their money is going to be taxed at retirement? One of the big arguments you'll hear is that, well, you're going to be in a lower tax bracket in retirement. Okay, you'll hear that all the time, and that may or may not be true for some people. And if you ask your clients, the perception is, if you ask them, how are income taxes right now? How much taxes are you paying? Is it high or low? They'll say, wow, it's higher than ever. It's really bad. And I want to kind of look at things historically to see whether or not that's true or not. I've graphed out here the top federal income tax bracket since it was inception in 1913 through today. So when it was first enacted, the top income tax bracket was 7%. Okay, you see a huge spike here. Okay, what is this? Okay, this obviously is World War I. Okay, huge tax increase. That was the War Revenue Act passed, and huge tax increase into the mid-70s. Okay, to fund that. All right, comes back down, Great Depression, and it spikes way back up again. Okay, what is it? This is World War II, right? The U.S. enters that in 1942. Tax rates go all the way up to 88%. Okay, huge. At the very worst, the top federal income tax bracket in the U.S. was 94%. Okay, when you combine that with state income taxes, basically somebody in that bracket would just be paying everything they made to the government. So there's no incentive to work at all. All right, everything it comes down. It actually stays high for quite a while. Comes down now in the 60s and 70s. It looks like it's a lot lower, but let's remember that's still 70%. All right, huge chunk. Comes way back down. We have a low here in 1980s, 88 to 90. So what was happening there? It looks like it was really low. 28% is what it was. However, behind the scenes, what happened there is that the max tax bracket where you start to pay that amount was the equivalent in today's dollars of $57,000. Okay, so there's a ton of people qualifying for that now. So the tax base has been incredibly broadened at the same time that the rate was brought down. Okay. Now, what are we doing? Well, the top rate of 39.6, and that's on an equivalent of 465,000. I say all of this to bring up the point that income taxes actually are historically low right now compared to where they have been in the past. So let's keep that in mind as we go along. 1935, what happened? Social Security was enacted. All right. 1940, however, was the first year that benefits started being paid out to anybody. Okay. At that time, 42 to 1. There were 42 payers into the system for every one person that got money out of it. Okay, that's pretty solid. 65 was the age you could start taking benefits. 62, what's that? 62 is the average life expectancy at that time. Okay, so you can see 42 to 1 funding it, average life expectancy 62, and you can't take it till you're 65. Of course this plan is financially solid. Okay, and for somebody that actually made it to 65, they used it on average for 12 and a half years. Let's fast forward to 2015. 3 to 1. So instead of 42 to 1, we have 3 people paying in for every 1 person taking out. And that's going to go down to 2 to 1 pretty soon. Now you can take early benefits as early as 62. Your average life expectancy is 79. And for the person that uses Social Security, they use it for 19 years on average. So you can see there's been a huge change here. Part of that, of course, is due to the baby boom generation retiring. Part of that is due to the hugely increased life expectancies. So all of this adds up to a retirement plan that many Americans are counting on that is very much projected to be insolvent as early as 2033. Okay, so there was a quote on this, interesting quote, that was actually by David Walker. He's the former Comptroller General of the United States. 4-letter word to describe why Social Security has to be insolvent, why it's going to go insolvent. A lot of people, when asked, will say, oh, debt. Is it debt or wars? Wars have caused our taxes to go way up. His response was math. Social Security is doomed by math, not by anything else. Okay, so we have historically low tax rates. We have a retirement plan many Americans are counting on that's going to be insolvent. What about the debt in this country? How's that looking? 19 trillion, a huge number. It's almost unfathomable to think about this number. So I wanted to break it down in an interesting way here. If you were to take 1 million seconds, how far back in time would that be? That'd be 11 and a half days, okay, less than 2 weeks. If you took 1 billion seconds, that'd be the year 1985. What about 1 trillion? That would be the year 29,693 BC, okay? Trillion is a huge number, even compared to billions, and our debt is 19 trillion at this point, okay? So why do I bring all of these things up? Where do we think taxes are really headed? Are they historically high? Are they going to go down? Are they going to be level? Are people actually going to be paying less taxes in the future and be in a lower tax bracket? We have historically low tax rates, out of control national debt, and an insolvent retirement program. And if you think that's bad, Medicare and Medicaid are even worse. And when you combine Social Security with Medicare and Medicaid, that makes up 48% of the federal budget right now. So these are huge programs that are destined for failure, okay? So I think people are actually going to be inevitably paying higher taxes in the future. So what do we do with that? Let's look at what retirement account options people have, okay? There's really 3 main areas that people can put their retirement money. The first is in taxable accounts, mutual funds, CDs, bonds, etc. Why do people use these accounts? Because you're paying taxes on the money you get as you earn it. You're paying taxes on it as you earn money in your investment. So why would you do that? Well, liquidity obviously is the answer. You can get to this money quickly if you need it, okay? So that would be the main reason why somebody would have money in a taxable account, because it's not incredibly efficient for retirement. What's another category? Tax deferred. This is where most people have the majority of their income, right? majority of their retirement money. Your 401ks, your traditional IRA, and actually potentially up to 85% of Social Security ends up being taxed as well. So that would fit into this category as well. So this money, obviously, you're not taxed on it as you get it. Okay, you're not taxed on the seed. It grows tax deferred, but you're taxed on the harvest. Okay, so you don't really know how much money you're going to have in retirement because you don't know where taxes are going to be, right? Okay, and what's the third type? What I call tax-first accounts. This is often called tax-free accounts, but it's not really tax-free, right? Because you're going to pay tax on the money as you get it, but it's going to grow tax-deferred and be tax-free in retirement. Municipal bonds is one option. Now, these, of course, are incredibly low yielding. It's a fixed investment strategy in bonds. This really just kind of keeps up with inflation, maybe. Okay, it's not really earning you anything. Roth IRAs, this is a great option for your clients, obviously, for many of them. You're going to have market yields, probably in mutual funds inside of the account. The problem with Roth IRAs, right, is that there's contribution limits. So unless you've been planning very well throughout your life, you may not be able to get enough money into it. You can only put $5,500 in, or an additional $1,000 if you're over 50, so $6,500. And the biggest thing here is a phase out. Okay, a lot of your clients, a lot of your wealthier clients, they cannot set up a Roth IRA for themselves, right? Because the current cutoff in income to contribute is somewhere around 180 a year, something like that. So you have a lot of clients that don't even have this option. Okay, so what's the final one? Life insurance. Okay, several quote investment accounts available. If you had a whole life, it's going to be dividends from the company and bond type returns. If you have an index policy, it's going to be tracking some sort of index like the S&P 500. The nice thing about this is you don't have any contribution limits. Okay, you can put in as much money as you want, as subject to, of course, financial underwriting. How much face amount can you qualify for? And there's no phase out. You can be incredibly wealthy and still contribute to this plan as much as you want. In fact, wealthier people would probably qualify for more face amount and could put even more money in. Okay, so we've talked about what the retirement problems are. We've talked about tax rates are probably going up, so your clients are actually not going to be in a lower tax bracket in retirement likely. We've talked about Social Security being a problem. That's probably not going to be there for a majority of your younger clients. Okay, and the debt level of the country is going way up, so taxes are probably going up. So doom and gloom, but what's our solution to this? The life insurance retirement plan. And why? Why is that our solution? It's got a lot of things going for it if you think about it. It's a self-completing plan. What do I mean by that? Well, it has a death benefit. It's life insurance. Okay, if you make one payment into this thing and die, your beneficiaries, your wife or your kids or whoever it is, are going to get that tax-free death benefit. Okay, self-completing. Tax-deferred growth. Money that you put into a life insurance plan is not taxed as it grows. Okay, tax-free retirement income. Now, how does that work? So if you structure a plan properly, you can take loans out of your contract that are not taxable to you. And we have a lot of plans. I'm not going to talk product really today, but we have a lot of plans that actually give you a guaranteed wash loan. So they guarantee you that, say, they're going to charge you 3% on a loan, but they're going to credit you internally 3% on that same loan. So your client is not taking an additional interest rate risk in retirement through that life insurance plan. Locked-in growth. What do I mean by that? Well, all of our index products have a 0% floor. So say you earn 13% one year, and then the market crashes and it's negative 20. Well, your client didn't lose money that year because there's a 0% floor. So it has that safety net feature. No RMDs, right? This is not a qualified retirement plan, technically. So it does not have any required minimum distributions. You can leave the money in there to accumulate. You can take it out whenever you want. There's not a 59.5 restriction, nothing like that. So it's pretty flexible. So how do we make this work, briefly, with a life insurance plan? You can use whole life, and we do. That's a less, I would say whole life is kind of on the lower risk spectrum. IUL is kind of in the middle, in between whole life and variable, okay? What we're selling most of for this is indexed UL. I think it's a very efficient vehicle, and a lot of our carriers have developed great products for this. So how do we do it? Well, we want to have a maximum non-MEC premium. What does that mean? That means that, you know, normally with life insurance, you're trying to get as much death benefit as you can for the lowest dollar output. So this is totally different. We're actually trying to get in as much money as we can for the lowest death benefit. Why? Because that reduces the cost of insurance and increases your cash growth. An option 2-to-1 switch. So what I mean by this is that when we start the policy, we're going to have an increasing death benefit. Okay, that allows us to get a lot more money in without creating a modified endowment contract. Okay, and then in retirement, whatever age that is, we switch it on to level option 1, which lowers the cost inside the policy and allows us to take out as much money as we want. And then in retirement, we're going to take loans. We're probably going to withdraw the basis. Okay, so we're going to draw out all of our money that we've put in as a withdrawal, and then we'll start loaning. So as long as your policy does not lapse, that results in income tax-free retirement money. And there's a lot of mechanisms to keep the policy from lapsing. So at the Milner Group, we like to be on the cutting edge, but not the bleeding edge. So we like to be very conservative. So we're going to take a hard look at what the cap is on the product, and we're going to compare that to other products. And so we're not going to run every contract at the same interest rate. We're going to choose a conservative rate, and we're going to run them based on their caps so that they compare to each other the way they should, fairly. We don't really tout variable loans in retirement because it's an extra risk factor. So we don't show all that extra arbitrage that some people show. We tend to show fixed loans, which are a guaranteed wash. Okay. The third factor is there is an overloan protection rider with most policies you can add on that as long as you follow these guidelines and set it up like Milner sets it up for you, the carrier will actually keep your client from overloaning the policy so that it doesn't lapse on them. So say that the client's policy doesn't perform as expected, you know, not quite as much as you thought, and they're taking out more money than they should. They get to a point where it's going to lapse. The company is going to call and they're going to say, look, the policy is in danger of lapsing. We don't want you to get an income tax bill. So what we're going to do, if it's okay with you, is we're going to reduce the face amount drastically. We're not going to allow you to take any more money out at this point, and we're going to guarantee that your policy stays in force for life. That is a great safety net feature, especially as we see, you know, old current assumption policies that were illustrated way too high that are crashing and burning now, and people are getting huge income tax bills. We see that regularly. This is kind of a refreshing feature. So that combined with our conservative approach to illustrating these, I think is a really a good path for you and for your clients. So when should you set this up for your client? I get this question all the time. Well, optimally 18 to 50. Anywhere in this range gives your client plenty of time to put in money and to build a good nest egg in there that they can draw against for the rest of their life. So at 50, you know, we might set it up as a 15 pay or possibly a 20 pay even. That's plenty of time, okay? But can you do it from 51 to 60? Yeah, it's still suitable. We can do this on 60-year-olds and do a 10 pay and still make it work very nicely. So I would say optimal 18 to 50, but don't discount people from 51 to 60 because they still may be a very good candidate for this, especially if they have extra funds and they can fund it at a little bit higher level. So the big question you're going to run into is, you know, is this all just salesmanship? Okay, why are you selling me a life insurance plan? I mean, I've got somebody, you know, taking care of my retirement plan already. I've got funds in my disqualified plan. I've got mutual funds, all this kind of stuff. How does it actually compare? Well, I've done a conservative comparison here where we've got a 45-year-old male or female, doesn't really matter except the life insurance is on a male here. It would work the same for a female. 20 years of investing, okay, $25,000 a year from 45 to 65. This one right here on the left is it is set up as like a 401k plan, okay, and it's a tax-deferred account that is investing in a retirement target mutual fund. There's no load on there. I put a 0.8% management fee, which is fairly typical for, you know, a low-cost fund like that. Okay, so they're putting that money in. At 66, they turn on their income, start taking out $58,000 a year. Okay, if they do that in this retirement plan, they run out of money at the end of age 85, and they're done. Nothing in there. If they had done this in an index universal life, average 6%. Now this product I showed has a cap of 13.5%. 6% is pretty conservative, all right? So they invest the same money in there. They have a death benefit from day one. They have all this cash growing. They take out the same $58,000 as withdrawals and loans. At the end of age 85, they still have $620,000 of cash in there and a $735,000 death benefit. Okay, so it's actually outperforming this other plan. And this other plan, look, I mean, I showed it at 8%, 7%, 6%. Basically, it's a target plan, so it's probably going to be reallocating assets and bringing down the risk level as they get close to retirement. At least it should be, because that's what it's supposed to do. So you would expect lower returns in retirement. We show 6% on this one the whole way through. So it's actually earning less a lot of the time than this other plan, but it does better. So those are real-world numbers I put together. Pretty powerful. By the way, when you're talking about cash value, I probably wouldn't use the term cash value with most people. I think it's confusing, and if you're not an insurance person, I'm not sure that it really conveys what it is. I would tend to refer to the money in your policy as equity. So you're building equity in your plan. And this equity is something that you can draw against and is very much treated favorably from a tax perspective from the IRS. Okay? What does it look like? Just briefly, here's an illustration that I slapped together. Somebody putting in, starting at age 45, putting in $1,000 a month through age 65. Okay, 6.5%. This is a 13.5% cap product, and they can take out $36,000 for the next 20 years, starting at age 66. Totally tax-free, and the policy lasts for life based on these assumptions. And this is with fixed, guaranteed wash loans. So very conservative. All right, so this is, I will send you something like this when you ask for an illustration, and we'll talk about it. Here's a few tips when talking to your clients about when setting up these sales, kind of broaching the subject, as it were. The first thing, not the first thing to say with your client necessarily, but one point I would bring up is don't talk about the death benefit so much. I would talk about what the premium commitment is. What could your client put aside potentially into a plan like this? Okay, because we are not trying to get a certain death benefit and then put in money. We're trying to put in a certain amount of money that works for your client and minimize the death benefit so it maximizes the cash value. So it's better for everybody if you start with a dollar figure rather than a death benefit. So kind of a shift in thinking there. Another thing is, if you can get your client to connect with their future self, all right, if you can get them to think about what things are going to be like when they're retired, this is going to help you out a lot. If you can make them think about, wouldn't it be great if you had plenty of money in retirement and you didn't have to worry about whether or not tax rates had gone way up. Okay, so you've got a tax-free retirement income source. Wouldn't that be great that you don't have to worry about all these crazy things that the government is doing right now in spending? Okay, so get them to connect with their future self. And one point I like to bring up is that being in a traditional qualified plan is basically like being in a partnership with the IRS, and you let them decide how much money you're going to have in retirement, right? Because they're giving you all these breaks, but they're going to tell you when you take your money out, how much, RMDs, right? And they're going to tell you how much you're going to give it to them in taxes, because they're going to raise the tax rates to whatever they need to at that point. So you're really in a partnership with the IRS, giving them control of your retirement. So if your client gives you the go-ahead to at least talk about this concept after you've briefly introduced it, they give you the green light, what I would say is give me a call, give somebody at Milner a call. We are here to help you to design these cases. We're here to help you sell them, okay? So I am available to get on conference calls with you and your client, okay? You are going to be the client's advisor, but I will be the expert on the phone for you to kind of guide you through the process and to make sure that in front of your client, it looks like you know everything about these products, okay? So that's what we're here for, is to help you with those things with your clients. We can help you, obviously, with illustrations and with underwriting support, of course, as we go along. You can call me or Andrew. Andrew is also very knowledgeable on these contracts and how to set it up, and we would love to help you out. So that pretty much wraps up my presentation for today. Like I said, think about which one of your clients, you probably have several, that would at least merit a conversation on this topic. Think about it, give them a call in the next couple of weeks, and get with me about setting up a plan for them, because I think it'd be something that really can help out you and your client. We have a place for questions. If you have any questions, you can type them into the GoToWebinar chat box, and if there's any questions, Dwayne will read them to me, and I will answer them to the best of my ability. Dwayne, do we have any questions?
Not currently. I do want to go ahead and mention to everybody we will be posting this video online as well for everybody once we're done.
We're going to post this video online, and also we have a blog post that is being put out on our website that is going to recap all of this. And then, like Dwayne said, if you want to watch this or give it to somebody else to watch, it's going to be a recorded video, and I think we upload them to YouTube.
Okay, let's see. I got my first question here. Please explain wash loans versus variable loans.
That's a good question, and that makes a huge difference for your client. Okay, I am not totally against wash loans in all scenarios. In fact, I'm not totally against variable loans, excuse me. Somebody that's younger and that's using the loans for some other purpose, maybe somebody that's loaning out for their child's, to fund their child's college or to fund a wedding or something, and they can afford to take a little bit more risk, fine. That might actually work out very well for them. But a wash loan is so much safer in retirement because we can guarantee them they won't lose money on the loan. So here's what I mean by that. You take a wash loan, it's called a fixed loan, okay? Wash loan is a way to describe it. It's called a fixed loan. The company, if it's one of the companies we use for this typically, they will guarantee you a certain crediting rate on money that's loaned out, let's say 3%. They will guarantee you at the same time that they will only charge you a maximum of 3% on the loan. So the loan doesn't end up costing you anything. Now with a variable loan, what's typically shown in an illustration and what your competition is they're definitely showing it because I see this all the time. They're showing a low variable rate. Let's say, this has kind of been clamped down on actually with new legislation, but what they're doing is they're showing a variable interest rate, say 6%, and then they're showing a crediting rate of say 7.5%. So they're showing an arbitrage in there of 1 to 1.5%. Now, pretty soon here you won't be able to show more than 1%. But my point is the money is being charged a variable rate and it's being credited whatever the index earns. So it's like that money never came out of the policy. The problem with that is it's illustrated positive arbitrage every year. So it looks awesome. But there's going to be negative years in that scenario, right? There's going to be times when the market has a downturn and your client gets charged 6%, but they earn 0. So that loan just cost them 6%, whereas with the fixed loan, it would have cost them 0 every year. So I think overall, that's way too much risk to maintain in that portfolio in retirement.
All right, so the next one here, basically asking if they can get an email with the link to the webinar. What we'll do is once the recording has been posted online, we'll go ahead and get the link and just email it to everybody that's on the webinar so everybody has a copy of it. And let's see, explain again the mechanics of the overloan protection.
That's more of an offline discussion because there's several things that go into it. But I'll give you a brief overview. Basically, one of the stipulations is you have to withdraw your basis. Okay, so the whole loaning from day one thing, that's automatically dangerous when you're using the variable loans because you're not going to have this overloan protection. So generally, you have to withdraw your basis, which is tax-free, and then you take loans. Usually, there's an age limit. You can't have your policy lapsing before age 70, let's say. Well, you would have done very poorly, and you probably took out way too much money if that's happening anyway. So as long as you meet those guidelines and a couple other small things, and that's all in the illustration, we can talk about that case by case, the company will guarantee that the policy won't lapse on you. So what they're going to do is they're going to call your client and they're going to say, hey, your policy is in danger of lapsing, and what we think we should do is lower the face amount and guarantee that this thing won't lapse. Otherwise, you could get an income tax bill, or you're going to have to put a lot more money in. Okay? So it's a mechanism where they reduce the face amount drastically to a very low amount, say $10,000. They suspend any more money coming out, so you can't take any more loans, and then they just guarantee that it's not going to lapse. Okay? Because lapsing, when you've loaned out more money than what you've put in over your basis, then that is an immediate income tax bill, right? So we want to avoid that. And that's what that rider is intended to do.
Hey, are there certain carriers you have that work through this, that you work this program through?
Yes. Most of our carriers have index UL products now, but there's a few of them that really stand out and are better than the others. They have better features overall for your client. Number one is North American. Okay, I would not hesitate to put anybody there unless they have a serious underwriting issue, because the underwriting's tight with North American. Otherwise, their products are great. They have wash loans. They have very high caps. They have very low cost inside the policies. They pay good commissions. Overall, it's a win-win for everybody. But we have several others that we use as well when necessary. Nationwide has a very good product. There's several others that we use.
Okay, and I believe that's all the questions. Oops, sorry, I got one just came up. Do taxes have to be paid on all money that is over and above what the client has put in?
Absolutely not. And that's why that's a good question. Maybe I didn't make that part clear. That's what makes us really sing, okay? So it's very similar tax treatment-wise to a Roth IRA. Okay, so you put money in that's already been taxed, it grows tax deferred, and you take it out tax-free. So if you were just to take your life insurance policy and just withdraw everything out of it, you would get taxed on whatever was greater than your basis, okay? That's why we're doing a withdrawal to basis, that's tax-free, and then we're loaning, because the loans are not taxable to you in a non-MEC contract. So you're going to withdraw your basis, and then you're going to start loaning. As long as you don't lapse the policy, you never get an income tax bill on that. Good question.
All right, and, right now I currently don't have any more questions on the board.
All right, well, that's going to wrap it up. Thanks, everybody. I really do appreciate your time. Please give me a call. I'd love to help you out on your cases. Give Andrew a call. We'd love to.
One more thing in closing, Jake.
Yeah, go ahead.
One more thing in closing. We do. Jake mentioned the blog site. If you're looking at the milnergroup.com in the upper right side, we've got blog there. We've got all of Jake's old webinars there. That's the place where you're going to find lots of resources and ideas on how to start conversations and present ideas. We also want to mention next month, at the end of February, February the 24th, that's a Wednesday at 10 o'clock, Jake is going to be sharing a sales idea that can really open the door to opportunities that you're currently missing. So we're looking forward to working with you this year. 2016 is going to be a great year, and we're excited to give you tools and resources and the help you need to be a great help to your clients and to increase your revenue while you do it. Thanks again for joining us, and we look forward to speaking with you soon or talking with you soon. Thanks so much.
Thanks, everybody.